Retail clicks. Institutions allocate. The system reprices. Everyone thinks the Federal Reserve is at war with Bitcoin. They're not. Because the Fed's real job isn't to win arguments on Twitter or stop crypto. It's to protect two things: the stability of the banking system and the dominance of the US dollar. And here's what most people miss. From the Fed's point of view, Bitcoin isn't a payment system. It's not a replacement for the dollar. It's closer to digital gold, a volatile store of value asset that mostly lives outside the plumbing the Fed cares about most. That's why you've seen something that looks contradictory. Bitcoin is allowed to mature, ETFs get approved, institutions allocate, and regulators focus less on Bitcoin itself and more on the on-ramps, off-ramps, and anything that touches the banking core. So no, this isn't Fed versus Bitcoin. It's something more subtle. Bitcoin functions like a pressure valve in the current system, whether policymakers intended it or not. And that creates an elegant setup. But elegant systems tend to be fragile. Retail clicks, institutions allocate, the system reprices. Here's the simplest way to understand the Fed's posture. The Fed doesn't panic about assets. The Fed panics about payments. The dollar's power isn't just that it's a currency. It's that it's the default unit for settlement, trade, taxes, banking, and debt markets. Bitcoin doesn't threaten that day-to-day layer. It's too volatile as money, too clunky for mass settlement, and it doesn't plug cleanly into regulated banking without strict rules. So the Fed doesn't see Bitcoin as the end of the dollar. It sees something more manageable, a speculative asset people choose to hold, like gold, that can be regulated at the edges without rewriting the core monetary system. Which is why regulation focuses on leverage, custody, intermediaries, and the places crypto touches banks. The point isn't to erase Bitcoin. The point is to contain the blast radius. Since 2008, the modern system has relied on a repeating playbook. When stress hits, liquidity expands. When liquidity expands, asset prices inflate. When asset prices inflate, inequality rises. When inequality rises, political pressure rises. That's the loop. And excess liquidity always needs a destination. Some goes to stocks, some to housing, some to private credit, some to anything scarce, and some goes to Bitcoin. Not because Bitcoin is approved, because it's useful in a specific way. It's globally accessible, finite, and capable of absorbing demand outside the traditional banking core. That's what I mean by a pressure valve. A pressure valve doesn't make a system safe. It makes it survivable, as long as the valve behaves. But that creates a dependency. Over time, the system starts assuming Bitcoin will always behave like a side market, a place for speculation, not a place for escape. A lot of you have asked for the full macro framework behind these videos, so I made it available. Module 1 of my Macro Investing Masterclass is free in the description as a thank you. Watch it whenever you want. Now back to the story. Now, if Bitcoin is the saving style layer, digital gold, stablecoins are the transaction layer. And this is where the system is genuinely brilliant. Because stablecoins don't weaken the dollar, they extend the dollar. They let people move dollars across the internet at the speed of software, 24/7, across borders, with settlement that looks more like email than banking. That's not a threat. That's a distribution upgrade. So the emerging structure looks like this. Stablecoins equals the dollar's digital payment rails. Bitcoin equals the digital gold reserve asset. One is about spending, one is about saving. And from the Fed's perspective, that separation is ideal. It keeps the dollar at the center of commerce and debt markets, while allowing an external store of value asset to exist without directly competing with the payment layer. That's the elegance. Here's the problem. This elegant system is stable under one condition: confidence. It works as long as people treat Bitcoin like an allocation, not an exit. But what happens in a real crisis of confidence? Not a normal recession, not a market dip, a confidence crisis, where people start doubting the long-term credibility of fiscal and monetary policy. In that world, Bitcoin's role can flip, and that flip is the fragility. Because instead of absorbing excess liquidity as speculation, Bitcoin starts attracting capital as escape velocity. And when that happens, two things change. Fragility number one, correlations rise when you need diversification. In stress, everything gets sold to raise dollars. The separate sandbox becomes connected through portfolios, ETFs, leverage, and risk models. Fragility number two, the valve stops being a valve. If flows become fear-driven rather than return-driven, the valve isn't releasing steam anymore. It's pulling steam out of the engine. And that's when policymakers don't just watch Bitcoin. They start thinking about bank exposure, funding markets, payment stability, and whether containment still works. That's why this should worry you. Not because the Fed will ban Bitcoin, but because the system's relationship with Bitcoin is stable only while Bitcoin stays in its lane. Delicate systems don't fail often, but when they do, they fail fast. So here's the real story. The Fed isn't fighting Bitcoin. It's tolerating Bitcoin and containing it, while the dollar evolves through regulated digital rails. Bitcoin becomes the savings hedge, stablecoins become the spending layer, and the dollar stays the unit of account. That's elegant, but it's also fragile because the entire structure depends on confidence. And confidence is the one variable central banks can't print. Retail clicks, institutions allocate, the system reprices, and the question going forward isn't, will Bitcoin go up? It's this, will Bitcoin remain a portfolio allocation or does it become an escape? If you want to understand these shifts before they hit the headlines, subscribe. We break down the signal behind the noise every week. And drop a comment. Do you think this two-layer system is stable long-term or stable only until it isn't?